Sunil Subramaniam, a market expert. So, sir, firstly, to start off with the auto sector. Now, we all knew that December is the month when discounts will come in for that will come in from auto companies to boost their sales. But how long do you see the weakness that we're seeing in the auto space right now, also because of a high base, will continue going forward? How for how long do you expect that to happen?
I think it will last till the middle of February. I don't see a quick turn on that because one of the things which is hurting, and these are the bottom of the pyramid in the auto segment, right? Two-wheelers are the lowest priced vehicles. And that's where the inflation has been hurting the consumer, and hence demand at the bottom of the pyramid has been weak. And I think until the monsoon forecast actually translates into lower vegetable and food prices and inflation eases, I don't think. Second is that an RBI rate cut doesn't look likely in December. So Feb policy, maybe you will see a rate cut. So I think that overall conditions should favor this. And then, March is usually a season when auto sales pick up because it's the year-end clearance and all that. So I think all of this excess backlog will probably get cleared at that time. So I expect this weakness to be there for the next month or so.
And in the auto space, which segment do you expect to recover faster? Will it be the two-wheelers? Will it be the four-wheelers passenger vehicle? Or will it be companies with more focus towards commercial vehicle and or tractors?
I think commercial vehicles are still some way off because the capex cycle recovery from the private sector is still taking time. So I would still bet myself on the entry-level SUVs in the four-wheeler space because I think those have caught the fancy of the Indian consumer because the price points as well as the carrying capacity is very attractive. So I would look at the entry-level SUVs as where the strongest growth will occur.
Right. Good afternoon, Sunil. This is Cheryl for joining in the conversation. And no doubt you spoke about the auto sector, but let's talk about the market as a whole because you had the big event pass by, you had the Q2 earnings pass by, you had the US elections done, the state polls done, and then you got the Q2 GDP numbers, which were a shocker in sense. We did expect it to come in much milder than expected, but it was much more than that. What's your take now? How should the market read into these numbers? Because your Q2 earnings weren't that good anyways.
See, the earnings coming week was a harbinger to the GDP number not being great. So that's why if you see the GDP numbers haven't impacted the market at all. Since the GDP numbers got published, the market has been rising every day. So I'm sure that market is a forward-looking animal, So looking at analysis of a Q2 GDP, which is already a month and a half or maybe even 2 months behind, right, is more like going an autopsy on a dead body. What the market is interested in is the way forward. Does that slowdown in the GDP indicate a continued slowdown in the economy? And that's where I think if you look at the October and the November prints, right, they have been very encouraging. We talked about auto now. The overall auto sales were up 32 to 36% for the Diwali month. So obviously a lot of inventory got sold then. You also saw the PMI numbers, right? Yes, marginally down 0.1, but at 58 and 57 kind of a numbers, you are in a very strong expansionary mode. And third is, market always likes to understand why something happened. And only if it's something which is beyond your understanding, does the market react negatively. So in this particular case, it was very, very clear that the government had kind of stopped the capex fight because of the elections, originally the national elections and then the Maharashtra elections. And a little bit of diversion was naturally there towards the schemes and all of that. So I think this mix played out there. And manufacturing and mining were the ones which dragged the GDP down. Now, with 46% about roughly of the fiscal deficit only getting spent in the first half, you have a 54% room for expenditure to step up. And as the budget approaches, if the government wants to budget for a higher capex for next year, they have to spend the capex this year. So I think the market is reading that the government will step up its spending in the coming months. The second factor which affected it was the high persistent food inflation. Now, the monsoon numbers have been good, but not yet translated to the ground in terms of an easing in the food prices. Now, with the cropping coming through and the harvest coming through, hopefully food inflation eases. The market is also expecting two things there. One is consumption to slightly pick up because inflation was hurting the pockets of the bottom of the pyramid. But more importantly, they expect a softer stance from RBI. Not that there's going to be a rate cut in December. I think most players are not expecting a rate cut, but definitely the language, the support to accommodation, liquidity easing, maybe a CRR cut, all of these factors has given a positive tinge to the market. So I would say that market is actually expecting a GDP bounce back in the next quarter, driven by the Diwali and probably the Christmas sales numbers to be reflected. So January 10th onwards, when the result season starts, and if those numbers play out, you will actually see that the GDP print for the next quarter will probably come by the end of February, right? By then, the earnings season would already be passed. So I think the market is already discounting that past bad news and expecting a rebound both in GDP and in corporate EPS to come through during this quarter.
Right, sir. Sir, if you're not expecting a rate cut in December, do you expect that to, when do you expect the rate cut cycle firstly to start? And how should investors position their investments in the financial space, keeping in mind that there is no rate cut right now happening and might happen in the next cycle?
So I think that the investors should still be positive towards rate sensitives because it's only that December is not going to happen. Now, if you see, I don't see this inflation as persisting at a high level with a good monsoon and all of that into the next year. And next year, it's not just one, maybe there'll be even two rate cuts through the course of next year. So rate sensitives will benefit over the period of the next year. So I think it's a good time for people to allocate money to rate sensitives, which is banks and financial services, auto, consumer discretionary, and all of those. I think it's a good time because while an immediate rate cut may not be on the anvil, it is definitely that over the next year, there will be at least a couple of rate cuts from RBI over the 2025 period. So I think that's the factor which should be in your asset allocation philosophy, not an immediate change.
Right. So that's what you have to take into consideration while you're doing your asset allocation. Then that brings me a key question. If you're talking about the asset class of equity, then which sectors should you actually look at in this market? Sunil, no doubt you did say that interest rate sensitives are something that should be on your radar. Also, you spoke about the auto sector. But apart from these sectors, which one do you think stands out the most?
So for me, the two big stories which are there, right? One is the US economy recovery with the Trump administration coming in, so a strong dollar and strong US economy recovery. So IT becomes a sector then, which should be a key part of your portfolio because a strong dollar, which means a weaker rupee, which means their rupee earnings will be higher. At the same time, a US economic recovery supported by Trump actions would mean greater order book for the IT sector. So apart from the rate sensitives, I think that's one. And in the rate sensitives also in the banking and financial services, the interesting part is that see, it's the BFSI space is no longer only a banking space. You have the right-hand side of the balance sheet, which is the investment side, right? So you've seen the SIP book growth, you've seen the mutual fund inflows growth. So all of that means the fee-based income from distribution of mutual funds, from insurance policies, all should also benefit the banks. And I see that financial services overall as a play in a time of a rate cut expectation over a period of a year is a very good. So your overall BFSI pack, which is banks, NBFCs, asset management companies, insurance companies, brokerage houses, wealth management firms, I think all of them are very good plays for the next year.
All right, so IT and the entire BFSI segment, the entire financial services segment, which include insurance, NBFCs, capital market plays also look attractive. Then where does that leave FMCG? You've not spoken about that particular sector. How does that one look, given the fact a lot of people actually put their faith in this sector right when you had the new government formation? Everybody thought now we'll see a pickup. You saw the entire sector rally, but then that rally fizzled off totally. It's seen a decline of about 9% or so in the last 3 months alone. So how should you be poised if you have taken a bet on the FMCG play, say in June or July?
Just wait for the next inflation print because inflation hurts FMCG both on the cost side and on the demand side. When inflation is high, people's consumer surpluses go down, so they will tend to spend less. They'll stretch that bar of soap for that much longer. They will postpone their purchases till they get the consumer surplus. At the same time, a rising inflation driven by rising commodity prices hits the margins because they are dependent on crude and related, biscuits depend on wheat crop and, soaps depend on crude. So inflation is a key thing for the FMCG pack. And I think only when you see the inflation turn around and start to fall, will FMCG again really pick up both from the EPS side as well as from the demand side. So I would say wait for that inflation print to come out. And if you see good signs, then you can continue to hold on to that space. But if you see inflation, kind of strengthening and sticky, then I would say maybe you reallocate away from FMCG at this point in time.
Right. So FMCG wait for the inflation print to come in, because yes, inflation is a very crucial factor when you talk about the entire FMCG space and the way how the consumption trend actually goes on. But Sunil, let's talk about the entire theme that was at play, and once upon a time we heard it a lot with every conversation, and that's China plus one strategy. What about that strategy now? Do you think that it's going to make a comeback, given the fact that despite the stimulus push, despite all the moves that the Chinese government has been doing or will be doing, the economic growth has not actually participated? So what's your view on that? Do you think the China plus one strategy will actually find back a flavor in the market?
Absolutely, and for a completely different reason from what you have pointed out. Okay, so I think China plus one is going to be big in the sense for us to look at it this way, right? Politically, what's happening is that India and China are making up at the border, respecting the LAC. You heard the External Affairs Minister speak to Parliament. He updated them. So clearly, the relationship is on the mend. Now, what is the reason for that? I believe that it's not so much political as economic, because China's biggest customer is America. And if Trump is going to put tariffs on China, what does China do with its production capacity? It will try to dump it on other countries. Now, that's one option, right? Now, those countries will be willing to buy it. But the more important thing is what China will do is China will try to enter into partnerships where they make part of the product and they finish the product in another market and export it from that market to the US. And India presents a wonderful opportunity here, provided we, on the political front, we are in better terms. So China plus one actually means that Chinese companies will look to India as an additional manufacturing destination from which to export out to the US. So China could very well beat the US tariff, implications by partnering with India. And for India, it's welcome because we have plentiful of labor, plentiful of land, and policy-wise. So I think this thaw in the political relationships which is happening is partly driven by the economic reality that in a new Trump world order, right? Probably China and India need to get together economically so that China's excess production capacity, partly substituted by India. So the PLI scheme will actually now see, and you see a few months ago, the government also made certain relaxation for Chinese engineers to come into Indian companies from a visa perspective. So I see overall that now there'll be a greater deal of partnership. I know this is something very contrarian, very controversial in a way to say that, but I see the winds of change happening along that, because if India and Mr. Trump also raised this whole issue of the BRICS currency, right? So he's building a wall against that. So if you have to skirt it, right, I see that the China plus one strategy working very well, not only as substituting China, but partnering with China to export into the advanced economies.
Thank you, sir. Thank you for joining us and giving us your perspective about the markets.